Hello, this is Matthew Morrison from The Practice, and it's an absolute pleasure today to have one of my partners, Craig Ridley, who heads up our lending advisory team within The Practice Personal Wealth Advisory team. Welcome, Craig. Thanks for joining us today.
G'day, Matt. It's my pleasure, mate. Thanks for having me.
I know from chatting to you previously that you have seen a lot of changes over the last few weeks where people could borrow a certain amount 6 months ago, and that certainly the goalposts have changed as of August 2018.
Yeah, they've changed enormously. Servicing's been hit probably the hardest. There's been a lot of changes in policies in terms of banks are now very adamant they're only after certain types of clients and they've all got their own niches.
Yes.
But servicing across the board has changed enormously. And by servicing, I mean the maximum loan amount that a bank will allow you. I'll give you many examples where a year ago a certain client qualified for a loan of so much and now it's substantially less. It could easily be somewhere between 30 and up to 50% less than they would have qualified for over a year ago.
Can you go through specifically how do the banks assess loans now and how do banks assess borrowing capacity now compared to, say, 2 years ago? For instance, with the interest rates and repayment types and those types of things?
It's substantially different. So the first thing foremost which has changed is the way the banks look at people's living expenses. They also what we call shade income a lot. So if you've got income which isn't PAYG, full-time basic income, then banks find excuses to not use that full amount in their servicing calculations. So for instance, the other day we had a truck driver who gets a lot of allowances and they would only use 80% of that income in servicing calculators. In years gone by, they would have just used the whole amount. And here's where the things have changed enormously. Previously, they used to use Australian Bureau of Statistic figures, basically, and just say, okay, it's a couple with 2 children.
Yes.
Your monthly expenses average approximately so much.
Yeah.
Now we need to go to the nth degree of proving what someone's living expenses actually are, and they will use someone's actual expenses. So somebody with a high disposable income would, generally speaking, spend a lot more living expenses.
Yes.
So therefore, that is now factored into the servicing calculation.
Even though they could easily find cash flow if they needed to by potentially cutting back on their expenses.
That's exactly right. And that's an argument we have with the bank all the time. But unfortunately, quite often it's a bit of a losing argument because their argument is that this is an established pattern of spending.
Yes.
Whereas our argument is if someone's buying a new property, they will, of course, adjust their spending accordingly. And here's where it gets really difficult. At the moment, a good good owner-occupied home loan rate would be around the, say, 3.7 mark. The banks presume that the rate is more like 7.25 to 8% in calculations.
Yes.
Now, that's meant to be a buffer so that if rates go up, of course, you're not too stressed and you can afford it.
Yes.
However, that's a substantial buffer.
It sure is. That's based on principal and interest repayments, isn't it, Craig, at that interest rate?
That's correct. So if you have an interest-only loan for 30 years and say it's 5 years interest only, a bank will actually calculate it over the remaining 25 years P&I.
The game's changing definitely, and look, as you and I have seen and the whole team's seen over the last 6 months or so, it is getting harder and harder for people to borrow to buy property or even refinance. Let's say, for instance, people who are actually on interest only at the moment, whether it be interest only on their home or interest only on an investment property, we're seeing that game change dramatically. What should people who are currently on interest-only loans, what should they be doing in terms of preparing themselves for when things change?
As the banks have seen this coming in, APRA have instructed the banks to be very conservative now when offering interest-only loans. So what you will find is a lot of people now, but moving forward in particular over the next 2 years, will expire on an interest-only period. They will expect they'll be able to go back to their bank and just say, we'll have another interest-only period, please, of 5 years, 3 years, whatever it might be. And the bank will say, no, you now need to start reducing this loan.
Yes.
Typically, your loan repayments will go up 30 to 40% if you go from interest-only to principal interest repayments.
It's a massive increase.
Which is a massive increase and a real burden on your cash flow if you're not expecting it. So we're actually, with a lot of clients right now, we're trying to position them well ahead of time to either make sure they're capable of paying principal interest in the near future.
Absolutely.
Or structuring now to another interest-only loan with planning for them knowing they're going to have to make principal interest in the future when this new loan expires. Sometimes it's actually not a huge difference to cash flow to take a P&I rate and make it slightly extra repayment than interest only, because the interest only is on a lot higher interest rate.
Yes.
And at least you've got the benefit of paying down the debt in the meantime.
That's right. And I think emotionally and mentally, as we chat to clients about it, it feels good if they're actually chipping away at the debt. But at the same time, I think it's never been more important for people to be proactive and look at what they've got and look what the options are. What it also does, in particular with investment property loans, it reduces the shock, say, of going into another 5-year interest-only period, and there's no guarantee whether interest-only loans will be available at all in 5 years' time. So it really reduces the potential shock of going from interest-only to principal and interest in 5 years' time over that shorter term, whether it be over 20 years remaining at that time or 25 years remaining.
And people are going to have to realise, unfortunately, moving forward, that they're going to have less availability for interest-only rates.
Let me ask you, Craig. So, for instance, with people listening to this or reading the book later on, who have an existing loan and they've been with the same lender for maybe 3, 4, or 5 years, and as I say quite a bit in the book, I'm a big believer in most areas of life, especially finances, complacency can cost us.
Yep.
What would you suggest with people who have actually been with a lender for the last 3 or 4 years? What should they be doing to make sure that they've got the right structure, but also their rate is competitive?
Yeah, look, I'm a big believer in reviewing your debt facilities on an ongoing basis. And I do think, as a broker, I do think you should go see someone independent.
Yes.
If you've been in your loan for 3 years,
Yep.
As an example, more than likely you're somewhere between 0.2 and 0.4% higher than what that bank would offer someone walking in off the street that very same day who's a new to bank client. So it's definitely something I think you should review constantly. Banks also constantly change their loan products and what features come with those loan products.
Yeah.
I think you should always be bank ready.
That's right.
If you're looking at buying a property, make sure you've got some form of pre-approval in advance.
Fantastic. How about self-employed people or self-employed clients, Craig? How are the banks making it difficult these days for self-employed people to get loans, and what criteria and financial information do self-employed clients need? Unfortunately,
it's quite a burden on self-employed people when it comes to getting finance, because a lot of banks, whether it's intentional or not, have dissuaded self-employed people coming to them via their income policies. So most banks use a 2-year average of your tax returns. As a basis when you're self-employed. Obviously, if you're on a PAYG wage, you are getting a set amount of income coming in, and the bank can grab your last couple of pay slips and check that, and they'll use those figures. However, when you're self-employed, it can fluctuate a fair bit. So banks, being very conservative, want your last 2 years financials. The best case, normally speaking, is that they'll average your net income over those two.
Yes.
Although quite often it'll actually be a lot worse than that when you go through the entire process, because if your second year is slightly worse than your first year, they'll use the second year's figures only. And of course, being self-employed, most people see it as a benefit that you get to potentially reduce your income a little bit come tax time. So if you're disclosing less taxable income, you're not going to get the loan that you want as well.
Yeah, people can really shoot themselves in the foot, can't they, by not necessarily declaring all their income.
That's exactly
right. Not have the borrowing capacity to build wealth and do the things they want to do.
That's exactly right. So we use quite a few, 2 or 3 banks that base their servicing calculations off 1 year's financials. We find that that's a bit of a niche for those banks that works well. However, generally speaking, you've got to have been in business at least 2.5 to 3 years.
Look, I'm a very big believer that it's never been a more important time to actually be working with an objective lending advisor, a mortgage broker who actually works for the client rather than, say, people going directly to the banks. Mortgage brokers and lending advisors who can use really the full suite of different banks and different lenders, look at other options. Just to put you on the spot though, what are some of the key reasons that clients should really look to use mortgage brokers these days as opposed to go directly to banks themselves?
I think this has changed a little bit over time, but I think the main reasoning right now would be the fact that there's been so much change in bank credit policy that if you go to a certain bank or just one particular lender, they may very well not have the policy that suits you.
Yes.
Every bank has certain niches, and every bank has different servicing calculations, and every bank has different policies, which with Bank A might work out really well for you, but Bank B, they actually either won't give you that or you'll be disadvantaged by it. There is some really large contrast between what banks will offer.
Yes.
And all you simply do is stay with your Bank A or go online and find the cheapest rate that you can and apply to them. The chances are that you're putting yourself in a situation where you might not get as much money you want, you might not get the features you need, or you might get, worst case, a decline.
Yes.
You need to find another lender who'll give you what you want, and unfortunately, by that stage, you've got a credit query with
yes.
First Bank already on your credit report.
And as we know, Craig, it's not just about the rate these days. There's a lot of people look for the cheapest possible rate, but there's so many other things: the borrowing capacity, the structure,
Absolutely.
what people want to do in terms of their broader wealth creation strategy, and also make sure the finance piece and the finance strategy really complements that quite well.
That's exactly right. I've seen a plethora of situations where on paper the differential in interest rates between option 1 and option B doesn't appear hugely significant.
Yes.
And some people would say to you, just looking at that, oh, it's not worth going to the other bank. I'll just stay with my current bank. But when you break it down and you look at the structure and then you look at the end result, it can be substantial. It can be very, very substantial.
And also just to mention a recent client that we all work closely with, and not to mention bank names and so forth, but they had a mortgage on their home and also investment loans on 4 investment properties.
Yes.
Through the finance review that yourself and our lending advisory team did, I believe we were able to save them about $15,000 in interest per year.
That's correct. That's correct. So they were with one of the big 4 banks in Australia, and on paper their rates were okay. You know what I mean? They weren't by any stretch of imagination. But by being able to restructure it and allocate the appropriate debt against the appropriate security, we were able to make some substantial savings there, as you said. And the key is now, with such differing rates between home and investment loans products, if you get the structure right, it can actually save you substantially just getting the structure right.
Yes.
There's a couple of things that are changing right now, which we haven't really seen in the Australian marketplace before. The first one is what we term exit strategies. Basically, anybody who is approximately 40 to 45 years old or more.
Are you saying we're old, Craig?
I'm saying we're old, Matt. That's exactly right. If you apply for a 30-year loan right now, the bank will look at you and say, well, wait a minute, you're going to pay by the time you repay this loan. So it's become a big thing where we need to provide what we call exit strategies within loan application. So we actually need to put time and effort into how will this client pay it back before their retirement age. And we have to put quite a bit of work into that. And that's one thing that by going direct to a lender, you actually have to do that yourself. Be a little bit daunting. Conversely, the bank will just potentially offer you maybe a 20-year loan term, which increases your repayments substantially, and is far from ideal. So that's one thing I wanted to mention that we've never had to deal with before, but it's now commonplace. And the last one is something called comprehensive credit report. So from now onwards, some people call it positive credit reporting, but I'm not so sure. But what this basically means is, in the very near future, everybody's credit report will have a 2-year history in there, month by month. So, Matt, if you've got a home loan and you were 1 day late on a repayment a year and a half ago, anyone who grabs your credit report can actually see that. If you're a month late on a credit card a year ago, we'll see that. So the idea was meant to be, in bringing this in, that by bringing it in, if a bank sees that you are perfect and have paid every single repayment on time, they'll offer you a better rate.
Yes.
Now, excuse the cynic in me, but I can't see banks dropping profit margin. So I suggest what will happen is that they will actually use it as a deterrent where if you have been late on a repayment here or there, they'll actually add a buffer to the rate. Then you have a positive outcome, you won't have a negative outcome. So what it actually means is, in years gone by, if you missed a credit card repayment, for instance, you would just wait a few months, get up to the date, and then you'd be okay.
Yes.
Now that will be on your credit report for 2 years. And so it's really important that we work with our clients to make sure that they understand that they need to pay everything on time, and it will have a flow-on effect in a huge way moving forward.
It will. That's such a good point. Thank you for raising those 2 points at the end there, because it's never been more important, is it, for for people to actually pay their loan repayments on time, right from credit cards or personal loans or even phone bills.
Absolutely.
That can also dramatically impact all of our ability to actually borrow money or refinance if we want to down the track.
Yeah, being late on a rates notice at the moment is viewed as a bit of a crime by banks, to be honest, or having a little bit of an ATO debt.
Yes.
Things that in the past wouldn't have been a big deal. At the moment, they could quite easily stop a loan application in its tracks.
Yes. Craig, look, I'd certainly encourage anyone watching this or listening to this or even reading this later on in the book to reach out for a complimentary finance review and lending advisory review. What can people expect?
Yeah, absolutely. It's a pretty, I like to think, pain-free process, Matt. We do need to gather a lot more information than in previous times. But what we really want to do is then sit down with you and actually work out what your goals are. If it's simply shopping around for the best rate, that's one thing. But we want to incorporate a hell of a lot more into that moving forward. And we know what we want to know what you in 5-10 years' time where your lending needs to be, so we can plan ahead.
Yeah.
So we do need to gather a little bit of information from you up front, but then we would literally go away and compare the entire market for you. So rather than you walking into your current lender and getting one perspective, we would literally come back to you with a view from everyone from a small credit union to a big four bank.
Yes.
Give you various scenarios that may fit your needs moving forward. So by contacting us, it'll literally be a quick conversation initially. We gather some information from you, but then we will be able to give you a really comprehensive recommendation, which is cost and obligation free, and just give you options so that you can plot your future more than just based off whatever the current interest rate is.
Craig, thank you so much. You're a wealth of knowledge. As I said before, I think you're head and shoulders above the lending advisors that I've worked with over the last 20 years. I'd encourage everyone to reach out for a complimentary finance review. And probably the best way to contact you is via our website, which is thepractice.com.au, or via our main number. I'll put up all the details on this video and also on the blog and in the book. Craig, thank you so much for your time.
Thank you for your time, Matt. Great effort. Good luck with the book.
Thank you.
See you, mate.